What's up, traders? Anthony Crudele here, and welcome to the Futures Radio Show podcast. Today, I'm joined by John Moser, a seasoned day and swing trader with decades of experience navigating the markets and multiple Fed pivot cycles. In this episode, we'll explore why John sees recency bias as a major pitfall for traders in the 2024 bull market, and how tapping into historical data can help you stay objective. John will share his approach to leveraging price action from past market events to gain key insights and an edge in today's trading environment. We'll also take a closer look at the macro landscape as we head into year end, focusing on the 2007 Fed cutting cycle and its parallels with the current market conditions. If you want to trade smarter and know when historical data matters most, this episode is packed with valuable insights you won't want to miss. Let's get started. Today's podcast is sponsored by TradeStation. As a futures trader, you can leverage your portfolio even more thanks to TradeStation's reduced margin rates across popular futures products, including intraday rates as low as 10% on select U.S. index futures and low rates on popular energy futures products like heating oil and gas. Open an account today and access over 600 CME Group futures products and customize your trading strategies on a sophisticated platform built for advanced traders. Please visit tradestation.com/Anthony to learn more. John, welcome into the show, my friend.
Thank you, Anthony. It's great to be here. I really appreciate this conversation. I've been looking forward to this for a while.
I have been too, and you came out hot with the SpaceX shirt, man. We're good. We're getting right into some SpaceX.
Yeah, we got to rescue a couple of astronauts in February, so I figured I'd go to pull a plug in there for Elon.
Yeah, I know. We were just talking about this. Really, I mean, I know you've only been on Twitter, or X as we call it, for a couple of years, but it's like even we can't help but call it Twitter still.
No, I can't. I joined in September of 2022, and you were the third trader I followed. The first was Brian Shannon. The second was Michael Silva, figuring out money. And then you were the third. And
cool.
I'm serious. And I didn't know what I was doing. A friend of mine recommended me to share my trading insights on that platform. I mean, I heard of Twitter, but I never used it. And then, you were the third trader I ran across. And I've been following you ever since. So.
Yeah, and I quickly followed you back, and I've been following your stuff for a long time. And
yes, you did.
I got to say, initially, the reason I followed you is just because I just think you're just really a stand-up guy. And it's interesting how you could be, I've always been a good judge of character when I meet people in person, but on Twitter or any of these social media, you never know. But your tweets right away, they resonate with me more as a person than they did, in markets. And then as time gone by, which we're going to talk about today, I just think that you have a deep understanding of markets. And I'm going to be curious to see how that kind of all came to fruition for you.
Thank you. And the same here. And this isn't a scripted comment I'm going to make. I admire you as well as a person. A person tries to help people. I mean, your tweets are always on a positive side, and they're never one-upping anyone else. And plus the fact you did something that a lot of us wish we did, which was work actually professionally in a pit, doing this kind of trading in an environment that I just go, wow, what was it like? Folks like Pax, Don, yourself. I mean, I love following you people because you've been there. You've seen a lot that we'll never see. And it's great to learn from folks who are professionally doing this. So awesome.
Boy, do I wish it still exists, because I think it would change so many people's perspective. I think that it would create such a greater respect for other traders too, because I was able to be around so many successful traders that there's just always somebody better than you. There's always somebody doing better than you right now. Yep. You have moments where you're doing great, and then you look around and you're like, wow, you did good, but you got to keep doing good kind of, situation. Yeah. I'm kind of plugging that Michael Douglas line. I always love that line, John. You go back. Did you ever see the movie Wall Street?
Oh, yeah. Several times.
One of my favorite lines is when he goes, just got 800K of Hong Kong gold. I just wired it to you. Now play with it. You did good, Bud Fox, but you got to keep doing good.
Yeah. I mean, but I love the end of the movie when he says, I'll always be just Bud Fox. It's like he just realized that he was trying to climb the wrong ladder, but just be yourself, just be who you are,
Absolutely. I mean, it's just so true. There's so many parts of that movie, I think, that I wish, people would even put that up there as the best movie of all time. I know Trading Places is always going to be right there as well. But, it brings us into, kind of where we started off, where, there's you got to have a lot of humility in markets. You've got to obviously want to do this. You've got to have the ability to lose. You've got to also have the willingness to win and then continue to build on, your success. There's so many different levels of this, John, right? It's not just one thing like, oh, I'm going to learn a strategy and start trading. And so I want to learn a little bit more about you and your background, because you've really become a very popular figure on X. And I know a lot of the people that I talk with, they're always like, man, that John, he's a great guy. And we love seeing what you're posting. How did it get to the point where you started learning about markets? I know it's not your background, so maybe start there and how you've developed this passion for markets.
It started when I was around 8 years old. So my dad never finished eighth grade, actually, and we grew up poor. I'm talking on a farm, dirt poor. I had 6 siblings plus myself. I slept in a hallway until I was 15 when my brother went to college and I got his room. But my dad was a wise man. I mean, yeah, he didn't even finish eighth grade because he took care of his mom when he was young. But he had this interest in the markets. Like, he didn't trade, but he loved listening to what the Dow did at the end of the day. So I would go on these jobs with him when I was 8 or 9 years old just to help out. And I would get in his pickup truck, and he always got in there at 4 o'clock, turned on Business 1060 out of Philly, and you would hear the Dow Jones Industrial Average closed today at 921 points. There were 21 advancers on the big board. And I'm like, Dad, what's a big board? And so he would just share this with me. And that's where it started, because my dad was interested in it. And again, he never traded, but he just thought it was interesting how these point values changed and these stocks are traded and all this. So that's where it started. And then I did my undergrad in business, and then I did my master's in economics. And then I just went into a career in biotech, but I was on the money side of the business. I wasn't smart enough to do the science and come up with the molecules, but I helped manage the money in terms of OPEX, CAPEX, that sort of thing. So I've always been in that. And then I started trading, I guess, in the early 90s, intermittently with a broker. And then in 98 or 99, I think is when I got my TD account. I was like, wow, I can trade myself. I don't have to call a broker and deal with all that, and $250 round trip just for 500 shares of something, back in those days. So that's where it all started.
You also wrote a book on behavioral psychology, which I think is interesting. And how has that played a role in your trading?
As we shared, before the recording, behavioral psychology is huge. I mean, price action is the reflection of decisions made by lots of people in an emotional state, whether that be bearish, bullish, or really no emotion, right? And so I think there's a lot to be said about what's going to happen on the right side of the chart. We look at the left side of the chart, but that's past history. What is the emotional state of people that's going to create a price action on the right side that we don't know now, but we can somewhat predict, with a fair degree of accuracy in terms of a longer term trading strategy on sentiment, or what's the mood of people at this given time as we move towards this election, right? The mood's going to change. It's going to get more heightened. It's going to get more anxious as we get closer to the 5th. They're neck and neck, these two candidates. That's going to get reflected in price action in the markets. I can guarantee that. That doesn't mean high or low. I'm not calling for a crash or a melt up. I'm just saying you're going to see that anxiety translate into price action.
Oh, no doubt. I mean, I have a couple of friends that have net worths of over 100 mil, and I talk with them, and they're pretty interesting guys. I mean, I'm down here in Naples, and a lot of money down here, John. And it's funny, I talk with some of those guys, and I'm always interested to see what they think. And they're like, you know what? A lot of them just want to be flat going into this election. They're like, I don't care what happens between now and then. A lot of them right now are telling me, they're like, I almost don't even want to be in the market, because there's just so, and these guys have money. They're not going to lose,
right?
Their wealth, they're invested in the market. I'm sure they've got a lot of other investments as well, but I always find it interesting because a lot of them will pick my brain about what I think about the market. And I'm always like, well, what do you think? And they're like, I don't know why. I just feel I don't want to be in right now. And this is several of them telling me this.
Wow. Right, because of the whipsaw. They just don't want to be part of that emotional gyration, because then they're going to get pulled into that. They're probably smart enough to realize, hey, I don't want to be yanked into this. I don't, because sometimes, and I've written this, I've tweeted this, it's better to stay out. It's harder to get out of a bad trade than be in a trade that you wish you weren't in, that kind of thing. You just want to be out, stay out. I see you tweet this as well. Pax does this every Friday, right? He calls it Cat Preservation Fridays, right? It's true. Sometimes it's just better to stay out. I don't trade during FOMC week, right before the FOMC announcements. No, if I scalp, maybe that's it, because it's just too much whipsaw. It's not worth the emotional headache to do it.
Yeah, and it's funny. It doesn't matter how much money you eventually have. People still don't want turbulence. They don't want to take risks that are unnecessary. And psychologically, you wonder how that plays into between now and the election. And I'm sure maybe we'll talk about maybe what you're seeing coming up between now and then. But I want to stay on your background a little bit, because something you mentioned to me prior to coming on today I thought was very interesting, and I think it's very applicable to so many traders, is that when you were knee deep in your business, starting back in the 90s, obviously pursuing a career, you've had a very successful career, and you were trading part time. And you said to me that in those moments that you were trading was actually a lot easier than when you became full time. Talk
Correct.
a little bit about that.
Because at that time it was a side gig, and yeah, I lost money, and I said this to someone on X last week. Everyone pays their tuition to Wall Street. We all do. I mean, this is how you learn. You learn from your losses. You learn from the bad trades. You learn from the stupidity. At that time, yeah, I lost some money, but I always had money coming in, from my biotech career. So if I lost 40,000 in the market, okay, that sucks, but I've got a paycheck. I've got a bonus coming next year. I got stock I can liquidate from this company. It's not the same as when that's not there anymore. And now this is the cash flow that's going to pay the bills, keep the lights on, and keep clothes on my girls, And so it's a different mindset when you're trading, I also say professionally or for your income, than when it's just a side gig. Totally different mindset. But by the same token, you have to be mindful of the things you're talking about is state of mind, being calm, staying out when you should stay out, and not trying to get money back that you lost yesterday. Those kinds of bad habits that can trip you up. I don't believe in getting money back. Every trade's a different business decision. That's how I see it. If the trade today didn't make any money, was a bad business decision. Tomorrow's a new business decision. Don't get into this rabbit hole of I've got to get that $1,000 back that I lost yesterday. No, I don't follow that track. That's a doom loop.
Yeah, but the hardest thing I think when you go from part time to the full time is that pressure shift,
Yeah.
right?
Yeah.
It's the pressure that you put on yourself. When you are making trades as a part time trader, you're looking at it going, I like this setup, and mentally maybe I don't know. What do you think about this? You were more obviously you were more passive with them because you were not watching them all throughout the day. But was it more of follow a straight setup, and if it worked or didn't work, you were more okay with the outcome? And maybe how has that changed as a full-time trader now?
As a part-time trader, for me, it was more macro focused. I'll be honest. Okay, so I'll use an example. The '07 to '09 period. I mean, it wasn't until mid '08 that we all realized things are just getting bad here. I mean, you just want to be short, right? I mean, it was just clear. And I didn't short the top in October of '07. I did not. We didn't know the top was really in until around the first quarter of '08 when, the S&P was now below a lot of moving averages. It was like, okay, time to just be net short here. And then I went long, and I started going long in January of '09. But I would just buy a chunk of like Bank of America. I bought Citigroup. I bought Ford. I would just buy these things intermittently as the market was going lower and lower, knowing that we're getting really close to, we're at past the 200-week moving average now on the S&P. This isn't going to bottom out. The Fed's going to step in here, and they did, right? They stepped in massively in March of that year. So when you're trading part-time, for me anyway, it was more macro focused. It was a lot less trading than I do now. It wasn't as often. I still made mistakes. Don't get me wrong. I'm not saying, I lost a lot of money in those early years. In 2000, 99, those did not do well. I did well in 99, didn't do well in 2000. But anyway, as a full-time trader, though, it's less macro focused because it's more swing trading. It's more day trading. You've got to be on top of your game every day. And you talk about this a lot. You've got to be mentally on top of your game. You've got to take time of rest. You've got to just treat this as a business. It's not just a gig.
No, absolutely. So how did you make that switch? What was your process in going from, working full time, having that income to now doing this full time?
Well, it was just because of my daughters, right? At that time, Anna was 12, Abigail was 16. I'm like, they're getting older faster here. And I just don't want to be, okay, I got to take vacation time to go to this dance competition or do something with them. They're going to be gone. My youngest is going to be gone in 6 years. My other in 4 years. I'm like, it's time. Okay. So that's what really was the switch. It was them and the time I can spend with them. It's like Friday. We just went out and did stuff. I didn't trade on Friday. I just spent the day with them. We did some shopping and we did some things around the house, stuff that doesn't sound like much, but it's memories that are being made that in 5-6 years, they're both off to college, they're gone. Then, okay, it was worth doing that. So the other thing too is trading they actually enjoy learning about this. My oldest wants to start investing next year when she's 18. She wants to open an equity trading account. So I want to teach them these tools so that they do better than I did because I was in debt when I was young. I did stupid things. I didn't invest. That's the other side of this. I want to teach them how to invest, how to do this so that they're better off than I was when I was 18 and 20 and just spent all my money.
So family reasons, freedom to be able to do what you want reasons, that's the backdrop. how did you actually go about having the confidence to believe you can do it? What was some of the process? What were some of the changes? What were some of the tools, education you did in order to actually make that switch and be successful at it?
The education wasn't too bad because at that time, we're talking 2023, I've been trading at that 26 years or so at the time I made this switch. And I want to be really clear, and you know this. I learn every day. I just started following Banana 3, super successful trader. I just started following him. Like, there was things he's doing. I'm like, you know what? I've never done that before. So there's always something new to learn all the time from other people that are really successul, like yourself. I read your tweet this morning. I'm like, yeah, he's right. In the quarter, that last 10 minutes is probably going to be, this is third quarter, and that's always a big one. And then what's going to happen, right? We just took off in the last 10 minutes of the day. I think the biggest thing was establishing a daily regimen, okay? So that's consistent. That did change. So for example, I get up at 5:30 in the morning every single morning except the weekends. And I check what happened in Asia, and I keep notes, and I, look at all of what's going on pre-market. And I do this every day. Then I have my calendar, what's happening this week. So I get the calendar ready on Sunday. Who's speaking at the Fed. I knew Bostic was speaking today. What economic releases are coming. You have to do all this prep work every single Sunday. This is what I do. And so it is a different kind of shift than before. I didn't care. I didn't even know when Powell was speaking when I was trading part-time. I mean, I may have known, but now it's a much more regimented approach. Big earnings. The earnings are coming out this week that can move the market. Things like that. You have to be on top of your game.
No, absolutely. And did you already have a technical approach, a style in mind? I mean, we talked about how really you were going more in the macro. And I think that everybody really starts off with some sort of macro backdrop because something drove them to be there, right? Whether you're following a stock or a company like Tesla or SpaceX and you're interested in like, oh, how does that work? Next thing you know, you're like, I want to buy that stock. What was the technical backdrop?
The technical thing for me, and you've probably seen this from my tweets, I believe in Occam's razor, which is the simpler approach is generally a better one. I use Yahoo Finance for charting and sometimes TradingView. I only actually look at a couple technical parameters: volume, RSI, momentum indicators, and that's about it. And I look at some of the key moving averages, the 5, the 10, the 20, the 50, and the 200. That's it. I think sometimes folks get so in the weeds with so many technical metrics that they just get lost in this and they don't even know what to do. But that's only part of the toolkit. The other part of the toolkit is sentiment. What is the crowd doing? And what kind of recency bias is going through the markets right now in various sectors? Because we could have oil doing one thing, gold's doing another, and tech is doing another. It's like all these things are moving around. You have to be on top of this depending on where you're going to trade. So I think the sentiment piece is huge. And I think recency bias is one of the things that as traders, we have to be really careful of. Last thing I'll say, and I want to get your comments on this, and I just shared this today with somebody. You can be wrong about your market forecast. For example, let's say I think SPY is going to drop 4 to 6% in October, and that's my call. And it doesn't happen. I can still make money. I was telling this to someone, just because you think the market's going to do something, it may not, but you can actually still be profitable as a trader if you can pivot quickly, get out of that. Don't marry yourself to a thesis. Never do that. The market may go the opposite way of what you thought. Fine. Pivot, get out of your trade, and then run with the market. So you can still be wrong on your predictions and still come out okay at the end of the day.
Well, 100% right, because that's the difference between being a trader and a buy and hold philosophy as an investor in a stock, right? If you buy a stock that's been in a bear market and you just hold it and it continues to go down exponentially over time, maybe you never make that back. But if you bought a stock in a downtrend and you caught the move as it was coming back up, you can make money. I mean, I think that people, because maybe they're not in our business, or even people in our business to stay, because there's so much, I think that people just come in and they try to be right mentally, right? They're like, I just want to be right. And then they come in and they're just so held by an idea that they haven't found a way to actually make money instead of just trying to pick the perfect direction. I think this goes back to where you go into your whole strategy, is that you really look at up or down. Right. And so on a day like today, I was waiting kind of till the end of the day to see if I could find a time to be long. Obviously, there was a big dip. People made money short today. I made a little bit of money being long. I mean, I took a small little piece out of it. Did I overall know that was going to happen? Was I necessarily right? No, but I waited for a moment where I can be right, in a sliver of the day.
Right, exactly, which for me is POW. So I want to get into this topic because one of my core, I should say, trading approaches is what I call situational trading. What does that mean? Well, whenever Powell speaks, that's a situation that recurs. And the market tends to rise, I don't say every time, but predominantly it tends to rise into a Powell speech. no matter where he's speaking. It did that today. And then it tends to fade when the speech ends. It did that today. So does it do it every time? No, but it does it 7, 8 times out of 10. And so I traded that. And sure enough, I mean, when SPY was down $2 or $3, I got out. I'm like, this isn't going to hold. We're not going to go down on the lows on the end of quarter. No way. And so, yeah, it's those situational things that come up all the time that you can take advantage of as a trader with a high probability of success. The problem is when you tweet this on Twitter, someone says, oh, but you said yesterday that's why I was going to do this. Do you realize I'm a trader? That was yesterday. I got out of that thing. I'm in something else now. People just don't get it. I mean, it's just they hold you to something, not realizing you're in and out of this stuff sometimes faster than, you can say blink.
Oh no, and do you use options quite a bit too, don't you?
Yes, I only trade 3 things. So essentially, I trade SPY. Almost 90% of all my trades are SPY, whether it's the ETF long and short or options long and short. I trade Dow Futures. I've been doing Dow Futures for 8 or 9 years. And I'm not saying this as a bragging thing. I've had bad years with SPY. I've never had, and I'm serious, I've never had a losing year with Dow Futures since I started trading them. Now, I don't trade them that often, usually just a couple times a month, but that's been a really kind of a sweet thing for me. Again, I don't trade them a lot, but I like futures. And then once in a while, I trade the VIX. So like a VIX ETN, like SVXY or UVIX or something. That's kind of my core. I dabble in a stock or two. I did Oxy this week for options. I did Walmart last week for puts, which did okay. But I don't trade a lot of stocks. It's primarily SPY, I'd say 90% of the time.
And so why Dow Futures, not S&P futures? Why not diamonds instead of Dow Futures? I mean, I'm just curious why one's the ETF and the other one's futures.
Yeah, so why, and I've been asked this, why not the Qs? Because here's the thing with Dow Futures. So Dow is 30 stocks. The variability is just not as great as when you have 500, or it's just the math, right? And so if you look over time, Dow Futures trade in a much more, I'll just call it rhythmic way than the S&P or SPX does, because you only have 30 companies in there. It's the smallest of the indexes. It's smaller than IWM. It's smaller than the Qs. And so again, I'm just going back over years and years of doing this. It tends to be, I hate to say this word because it can come out the wrong way, predictable. It's not predictable in the sense I have losing trades in Dow Futures, don't get me wrong, but it's just more predictable because you have fewer stocks in that index that are going to account for variability.
Well, you're going to have a lower volatility, and you don't have the 0 DTE impact that you do in SPX,
Correct.
SPY, and ES. I mean, I think that's probably one of the biggest things. I mean, I've talked to a lot of people about this. I said, I look at all of the indexes. I trade futures for all of them. Towards the end of the day, those 0 DTEs, I don't care who you are, they impact the price of the S&P. And sometimes you're going to catch it right, and other times you're not. They could totally change how a day goes out, not necessarily how a day starts. Could happen, but I agree with you on the Dow future side of things because it doesn't have that variable of that 0 DTE that's really going to move it a lot. And plus you have, like you said, 30 stocks that are really, they're meant not to be that volatile. I mean, those are, they're Dow Jones stocks. They're not meant to be moving up or down 3% to 5% a day. If they do get that move, typically 1 or 2 of them, if they have that move, it'll sway the index the entire direction of that day. So I understand that.
Yeah, it's the beta. I mean, the AT index was designed to be low beta. You just J&J, it might move $1 this week. Who cares? But that's not the case. The Dow has obviously got more volatile, and if they add 0 DTE to the mix, it's going to kill it for me. I'm not going to be happy.
Yeah, well, it probably will change it. And I don't even know how many of those stocks in the Dow, honestly, I don't even know how many stocks independently have 0 DTE. I'm not sure of that. I know some I'm sure do, but it's not. Obviously, it's prevalent in the SPX. That's where the volume is, the S&P. I want to go back to the situational trades because I do believe that a lot of traders understand what you're saying. I mean, I totally understand what you're saying. You talk about the 3-point move on the Fed, 3-point move almost on a Powell day where it's like, a rally into it, break, and then a rally back, or vice versa for other things, right? Where do you think most people go wrong with trading a move like that? Because most people do see what you're saying, but most people either are not consistent with it or they just ultimately lose in it. But you're successful with it.
Correct. And it's something that PAX talks about a lot. It's really the risk management approach. So I'm going to give you a situational trade. You can backtest this. I've already done it. So the FOMC announcements, they're on Wednesday at 2 p.m. Backtest this. I go back 10 years, 12 years, as far as you want. 80%, or we're still at 80% because I just did the latest calculation. 80% of the time, the S&P will open the next day the opposite of where it closed when the FOMC day wrapped up at 4 p.m. So I call it the FOMC flip. So I started noticing this probably in the late 2000s. Like, why is it that the day after we rally if it closed red during the announcement day? So I started tracking this thing and I started trading it. So I just called it the FOMC flip. So what I would do is just trade the same amount of money, $500. The next day I'd buy either, calls or puts, depending on how the market closed on the FOMC announcement day. So what happened on the 18th? SPY closed down $1.67. What did I do? I bought the 569 call for 22 cents, $500 worth. What day opened the next day? $3. That was the day we had the gap up the next morning on Thursday. FOMC flip played out again, 80% success rate. So I was talking to someone on Twitter about this. I said, would you take a trade that had an 80% success rate? Because he's like, well, you don't know. It could still go bad on you. You got a 20% risk of losing. I said, but how many trades can you make with an 80% success rate going back 12 plus years of backtesting? Not many. Okay, so and if you do the same amount of money each time, over 8 out of 10 wins, you come out pretty good. I've been doing this FOMC flip now for over 10 years. Why does it work? I have delved into this thing. Is it due to some rebalancing thing at the repo facility? I don't know. All I know is it works, and you can backtest the thing. I'll do the same thing in November 6th, when they do their announcement. I'm going to just go the opposite way at the end of the day, $500. I just did the same amount. It's that kind of thing. It's just managing your risk. You don't YOLO into this. If I had YOLO'd into it on the 18th, I wouldn't be talking to you. I'd be on a yacht down in the Caribbean somewhere, because I would have. Yeah, I wouldn't have done that though. But I'm serious. 22-cent call the next day is $3. It's a pretty good move.
And it's probably because I think what you're saying, and I believe I agree with this, is that people do see things like that. I think that most traders have a really good knack for noticing these types of patterns. I think we all have that inside of us. We're all some pattern recognizers. Some people see it by looking at the dome. Some people see it by looking at a chart. I'm not somebody who looks for like head and shoulders, but some people they could spot them out of a 1 minute, 30 second, 5 minute chart. They just see them. Visually, people see patterns.
There's a whole slew of them. I have a whole calendar of these things. The last trading day of June, 8 times out of 10 is red. It's the biggest rebalancing day of the year. Every first of the month, 7 times out of 10 is green. The half days before Thanksgiving and Christmas, 7 out of 10 times are green. I got a whole slew of these things. And if you just trade them with small amounts of money, it's amazing, because why? It's human behavior. They're doing the same things. People feel good around Thanksgiving. They feel good around Christmas. First trading day of the year, almost 8 times out of 10 is green. Why? Are feeling it's a new year, new start. This is all behavior-based stuff. And if you just make a calendar of these, you can have about 30 or 40 trades a year that have a high probability of 7 to 8 out of 10 of winning, but you just do a small bet. You don't YOLO. And you can add quite a bit of money to your winnings just by these situational trades like fading Powell and things like this. Do they win every time? No, but they win pretty darn often. I think 7 out of 10 is good enough for me. From a batting average standpoint.
Yeah, and I think that it just really comes down to that your position sizing is what's allowing you to do this.
Correct. Yeah, it's all
that is it. I want to talk about that a little bit more, because I think it's so interesting, because you're not super structured. You're structured. Maybe I'm saying this wrong. You're not structured in the sense of, I'm going to wait for an uptrend, on a 5 minute chart to hold once, and then I'm going to buy it, or I'm not going to wait for an 8/21/34 cross or something. Nope. You're not structured. You're not systematic, I think, is more of what I'm saying.
Correct.
You are discretionary, but you have things that you know that you like to trade because you believe the math is in your favor. That's where you believe you have some edge. And for you, it all comes down to, I can trade all of these, or as many of these as I like, or I put it into my playbook. It just comes down to how I position size them.
Absolutely. Let's talk about the moving average on SPY right now. It's above all of them. It's above the 5, which that's all that matters to me. It's in a bullish context. There is no way I'm going to buy 500 contracts of puts on SPY when it's trading above the 5 DMA. That's just a basic right there. And so if you just establish that as a framework, okay, we're above all the moving averages, we're in a bullish context. The only thing you're going to do is scalp, which is what I did when I faded Powell today. We lost $2 on SPY, but what did we get? I don't know what the close was, because I came onto this. I think we were up 270-ish on SPY at the close, somewhere around there. So that's a $5, $6 peak to trough. No, I scalped and got out because we're above all the moving averages. No way am I going to take a large put position if trading that way. Now, if we were down at the 10 or the 20 and we did an intraday and got to the 10 and then failed, I might take a larger position short because we failed at the 10 DMA. Okay, that's showing a little more bearish context. So I do look at that from a position sizing standpoint.
I want to go back to what you'd said earlier about recency bias. We
Mhm.
just finished the third quarter today, and I'm curious when you say recency bias, take us through exactly what that means because I'm not even sure I exactly understand what it means, and
Yeah.
just what your maybe your current recency bias is as we come out of Q3 heading into Q4.
We all have biases, right? And I certainly do. So recency bias would be the market's been up for pretty much since the August low on the 7th. That was when we did the retest of the August 5th low. And we've been pretty much on a tear ever since. We had a little pullback in the first week of September. But other than that, we've been making new highs, right? So recency bias says, well, we're only going to keep making new highs because that's what we've been doing. Yeah, but there's an election coming. Oh no, that's not going to matter because we're still making new highs and the market's going to be protected to get Kamala in office. That's what I'm seeing on that. That's recency bias. Whereas if you look at history, even the 2020 election, we had an 8% drawdown on SPY in October. And if you go back to all the elections since SPY has been in existence, I think SPY came in as an ETF in 1992, the minimum drawdown in October was 3%. So that's what history says. But recency bias is telling people, no, there's no pullback in October. We're going to moonshot right into the election. Then we're going to sell off. So I don't buy that. I look at history and I'm like, no, there's going to be a pullback in the month of October. Guarantee it. Whether it's going to be 2%, 8%, I can't tell you. But I can tell you that history is a pretty good guide here as people are going to become more anxious, like the friends of yours that said, we're not even going to be in the market. And these are big fish, right? These are folks with big money. And so to me, that's the recency bias. It's saying, no, it won't happen because we've been moonshotting since the quote yen carry trade blow up. And that's all over now. And it's all, cherries and apple pie. I don't look at it that way. I look at this election's contentious. It's close. We don't have a clear winner, depending on what poll you look at. That creates anxiety amongst people. They pull back spending. That's going to show up in volatility in the market. There's just no doubt about it. Look, I'm not talking about crashes. I'm talking about volatility, price swings like today, right? We had a pretty volatile day, I think, overall. So that's what I'm talking about is going to be the bread and butter for the next 4 weeks, is my opinion.
Yeah, and I would agree with that. We talked about psychology coming in. I don't think anybody is coming in and wants to be in full positions leading up to an election that really, I think whoever wins one way or the other is going to have impact on market prices. I mean, you could say what you want.
Exactly. And that's another situation. So the VIX is going to spike between now and probably towards the end of October. Then it's just going to plummet. Then I'm going to probably buy SVXY because the VIX is just going to crumble once the election's over and the cat's out of the bag and we know who won. Okay, this is just
market position from that point. I agree. I mean, at that point, it's because now the volatility comes out of the market, and so that's what you look at, right? You say if the VIX is going to start coming down, that should be bullish.
And these things come up, like I call them candy to a baby trades. It happened on August 5th. Do you remember that morning? The VIX was pinned in the 60s. It was like 7
I had just gotten into Lake Burton. I remember I was watching.
I remember it's like 10 after 7, and I see VIX 65. I didn't even think twice. I just went in and bought as many shares as I could in my one account of SVXY. Because I'm not like the VIX isn't going to stay in the 60s here. No way. We actually, I think, closed that day in the 30s, the high 30s that day. So in SVXY, I bought those shares at $37.50. I think at the end of the day, they were $44. I mean, that was a no-brainer. And that's the thing traders need to be looking for is those kinds of one-offs that ain't staying here. No way is the VIX staying in the 60s in August. It was just a complete fluke. But these things happen all the time, right? These kind of opportunities, you just have to look for them.
Yeah, no, you're so right. And but that comes with time, right? I think that's the one thing I really hope traders understand from listening to this or whatever it is that you're doing out there, wherever you are in your journey as a trader, is that you don't get to this point without time. I mean, you have spent a lot of time, even though you've only been full time for a short period of time, you spend a lot of time watching markets. You can't really put a value on that. I think sometimes when you look at things from afar, you're absorbing that knowledge, John, over time. And as time's gone by, is it now that you're doing this more full time, you've been really educating yourself just from watching these situations over and over and over for years. And so now that you're actually there and present every day, it comes down to those skills of position sizing that's allowing you to be prosperous.
In fact, I'm going to grab this. This is one of my favorite trading books. You probably can't see it on here. It's Nicholas Darvis. You ever heard of him? He wrote the book, How I Made $2 million in the Stock Market. So this book was written in the 1950s. The guy was a dancer, and he would get the prices through a cablegram a day or two after the market had closed. So he was getting old prices. They are too old. And he developed this box plot, type of, really, it was an archaic technical analysis. But what he was looking at is how was a stock ping ponging within a price range, like the SPY was doing, right? It was what, 540 to 560 was in that box for a long time. Then what happened? We had a breakout. So this is a dancer getting 2 day to 2 week old price action on stocks. He makes millions of dollars. In the 1950s, he writes this book. And if you do the inflation calculation, he made probably about 35, 40 million by using data that was old. Okay. So if someone can do that, and he just came up with a momentum indicator is essentially what it was. If a stock it was within a certain price range and then it breaks out or breaks down, then he would go long or short. If a dancer can do that over time, what could I do? Right. So I reread this book over and over because there's a lot of good nuggets of wisdom in there on how to look for these things and not be staring at a screen 24/7. And that's the other thing. And I think you touched on this in your video that you did at the lake. And I really like that is it's not just the trading. It's how do we calm ourselves down, take time for our families, take time to relax, go to the gym, get off the screens, get away from the markets, just have that downtime reset. I mean, it's really important to our mental health to be able to trade well. We have to be rested. We have to eat well. There's a lot more to it than just knowing charts and knowing what what Powell's going to say tomorrow. And you touch on this all the time. It's one of the reasons I like following you. It's not just the trading. It's how are we mentally fit, physically fit, relationally fit with our families, our friends. I'm a single dad. Like, I want to meet a wife someday. I'm not going to be able to meet someone if I'm just staring at a screen trying to get the next tick every 24/7. I just can't do that.
There's just so much more to life, obviously,
Yeah.
but we get so focused on the short term. I think as traders, people wouldn't know this about me, and it's funny that people that have known me, obviously, in my earlier years as a young trader, I was a very intense person, very much more hyper. You wouldn't think that now.
No,
Obviously,
no.
I feel like I've worked so hard at slowing things down just because I've made so many bad decisions in very short periods of time. It just rubbed me the wrong so hard where I was like, I can't handle why I keep doing this to myself, that I've actually worked so much on my breathing and other things that I want to just take things down to a very slow moving situation where I could slow things down in that moment and be like, do you really want to do this? Versus before, I'm just like, buy them, sold. And that's why I went from really a short-term scalper. It's not the only reason, but it's part of it is because I had to slow down my thinking. I had to slow things down without slowing down my reaction in my mind of what was happening, of processing. And there is that distinct difference, right? Because things are moving so fast around us, John, as you know, from social media, as you're really kind of knee deep in the Twitter X world right now, and just how markets are moving, news flow, that there's an overwhelming aspect to it, and there's an abundance of information. But if we can't slow it down, we're never going to make good position sizing decisions for the things that we see, because we're going to burn ourselves out to when that situation comes. We don't have the capital. We don't have it.
I call it the 3V effect, which means the volume, the variety, and the velocity of data is parabolic now, to your point. I mean, and it's 24/7. I'm talking about financial data. And so you've got to sift through this. Like, what is value and what is not? And am I going to burn up all my time looking at this? I mean, the volume, the variety, and the velocity. I have a question for you. In terms of what, if you were to distill the greatest trading lesson that you've learned over all your decades of trading, both professionally when you were in Chicago in the pit to what you're doing now with your own firm, what would be like the core lesson, like the core lesson that you learned that's given you the most success as a professional trader?
Man, it's hard to say, but I would say the way I look at things now that I wish I did back then was really time. All of what we've talked about today, the ability to slow things down and understand things that, a trader like yourself who was part-time, sometimes you can just look at the tape, or you could look at what was happening in '08 and see it unraveling. You could see some things happening during COVID, or other times where I'll talk to my friends that are in the markets and they're just like, because they're looking at it from afar, it's much clearer to them. So sometimes I think I know for myself and many other traders, we get so focused on the day to day that we've lost sight of to where we really are in the spectrum of things. And there are cycles. There are times where sometimes you get these layup type trade scenarios that, as long as you're in business during those times, and if you could slow things down and step back and see them, and that's why like Drunken Miller and all these other guys are so good, right? Because Those guys have the amazing ability to slow things down when everybody else is speeding up. You look at Tepper and you look at so many of these guys that have been able to make billions. Buffett means the best at it, right? And you look at them, and if you study them, the difference is if you look at all of them, they're very slow moving in the way that they are. Maybe not Tepper, but a lot of them are. But they're able to make a decision because at that moment, they're like, this is an opportunity. And so the way I look at it is that I just want to be able to be in business for when things are very clear to me and I'm able to see them from a little bit from afar, because that's when I'm able to step in and best handle that situation and make the most money out of it. I'm never going to beat the market every single day. I already know that. And so there's days where all of a sudden something's going to happen and I'm going to see it, and that's going to make up for the last 3 months where I didn't do anything. And maybe I'm not trying to like kill it with a home run, but it'll just happen. Right. And so I know if I'm around long enough, I'll make money. But if I try to make money every day, I may not be around for when I know I have an opportunity to make money, if that makes sense.
No, it's the lion approach. I just talked about this just this week or over the weekend. The lion waits in the bush. It doesn't go after a squirrel. It's not going to waste its energy on that. It waits for the right prey, like you're talking about. You're waiting for that right trade where you can make 4 or 5 weeks worth of income in one day. And then because you're like the lion, you're going to wait for the antelope or the wildebeest because that's going to feed you for a long time. And again, I made the same. I was always in it. I remember like my early years of trading, doing thousands of trades a month. I'm like, what the heck? That was just dumb. I was paying a lot of fees too at that time. It's just stupid. Now, I've gone last week. I think I did 7 trades last week alone, just 1 week. In 2 weeks in June, I didn't trade at all. You have to wait for good opportunities. And that still doesn't mean everyone's going to be a winner. No, not at all.
And the follow-up, everyone will always say, well, how do I know when those good opportunities are going to be there? That's what takes time, everybody. You're not going to just walk in and know when that is. That's not edge. The edge is that you see something that's clear and you can position size it well and execute it. The charts are never going to give you ultimate edge. It's about when you've seen something happen over and over and over again. At some point, you're like, this is a repeatable pattern I can execute on, and I could take a minimal risk for, potentially maximum reward in this situation. It's all it is. And it's not about the VWAP, the moving average, the Bollinger Band. That's there to help guide you in these moments of building up. Well, we go back to what we said before. I think that traders are naturally good. If you're in this business, you probably have natural instinct, enough intuition to be able to see things where you're like, this makes sense right now. I can take hold of this trade. But all those other times that you did things that were just like, this kind of looks good, or this is that, that's where the missteps make. And if you can withstand them and eventually control yourself in those moments, you're going to be able to afford yourself the time when things are clear.
And that's why, as you know, you can't copy another person's trading. You just can't.
It's too difficult.
I'm never going to have a Discord. I'm never going to have a class. No, because it's not going to work, because everyone has a different way of doing things and learning things, and they have different. It's just, to me, that is not something that I've ever.
You can learn a system.
You can learn a system.
You can learn how to be systematic. But if you're going to be someone who's pointing and clicking buttons, the only thing you're going to get from someone else is an idea that you're going to take and put into your playbook. And then you're going to have to figure out when that makes sense for you to do it. Because unless they're clicking it for you, you don't know how to position size it. You never know when to be big, small, or not at all. I've talked about this for a long time. I wrote this on my card 20 years ago. Deli, know when to be big, small, or not at all, because I'm always, I always wanted to be big. And at some point you're like, dude, that's just not working, man. Like you gotta pump the brakes a little here, brother. And so you learn these things from a systematic approach, but there are times and environments. I don't think we talk about this enough as well, John, where if we learn a systematic approach, at some point the market becomes very conducive to that system, right? So like I see this a lot with you, and I'm curious and what you feel about like rhythm, getting into a rhythm. Where like, I feel like I've even seen you get into some of these rhythms, these moments where you even, you talk about with the Fed, where you caught it, as it broke. And then you kind of know, because you got in a good rhythm in that, you get in a good rhythm to get out and then to get back in again. And you build that rhythm builds because you waited for that clarity moment. If you get into a moment where you're out of rhythm, you almost stay out of rhythm or out of sync, for a long period of time.
It's like playing guitar and you're out of tune and you're trying to play the song in tune, but you're out and the rest of the band's looking at you funny. But it's serious. You're absolutely right. And if I get out of rhythm, I get out. it's just not working for me today. I've had days where I've tried to trade and it's just not working, and you can't force it. And I learned long ago, don't force trading. It just doesn't work. It's like you have to step back. Like 2022 was easy. That was the easiest year for me trading in a long time, because it was a slow moving bear market. We had a peak and then a drop and a peak and a drop. It was just, I don't know how you did 2022. I think it was my best year. Now 2023 wasn't like that. This year hasn't been like that. No, it's been more bullish, but not. 2022 is so predictable. I mean, we had the low in June and then we rallied. Then I'm like, we're probably going to retest in the fall. Sure enough, we retested in October, and then it was off to the races. Did I call the low on the day? No, I didn't go long until I think mid-November. So other people were already going long at the end of October. But 2022, I'd love years like that. Not to be down, but just they were rhythmic. Like 90, 95, 96, 97, 98, 99. You remember those years. It was just boom, 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 boom. It was easy to trade. I don't think 2025 is going to be that way.
People will say, where are we in this bull market? It's obviously mid to late cycle. It has to be. I don't think it's the beginning,
Right.
and anytime you get in this cycle of a bull market, it starts to get a little bit challenging because you're going to have a lot of divergence within the indexes. Like right now, the NASDAQ is the laggard. It can't rally. The Russell is, who knows what that's going to do. You got the Dow leading up with the S&P, and that's going to continue to shift. It's going to come back and forth. And when you have indexes that are not working together like they were at the beginning of the year, where everything was going higher, maybe not Russell, but nonetheless, going off of maybe the end a year ago from November, it's hard to believe it's been that long when that rally happened. And that's when I actually do very well for me, where I think markets are very good for my strategy, is when I see all the indexes working together. Because now it's just like, okay, they're all holding a dip. I just, I get in as much as I can in the S&P because I have something to backstop it. But if I have divergences, like where NASDAQ's getting hurt or Russell and the charts look totally different, I struggle as an index trader. I wonder how that works for you. Do you look at the divergences?
I
Do you
do,
look at
and I struggle with them. I'm going to be honest. Look at 2000. The Dow topped first, and then the Qs topped in March. In
yeah,
2022, the S&P topped 3 weeks after the Qs in January. But they didn't, and so it was a different divergence. Now we got the transports are diverging from the Dow, from the industrials. Does that matter? I don't know. Is it? And like you said, right now we've got a divergence between the Qs and the S&P. Does that mean there's a warning bell coming? I mean, yeah, it's definitely got me a little off because we don't have that ensemble moving in one direction like we did for most of the year. I need to see how it plays out because I'm not calling a top. I'm just saying that for me, even okay, when do I directionally put all my ammo into one direction, right? It's not now. It's not before election anyway. I wouldn't do it anyway. But post election, I'm talking about what's the direction going to be here? I do think we're in, certainly the LEIs, the leading economic indicators, are showing a slowdown's coming. The Fed wouldn't be knocking off 50 basis points and they're talking about another 50 basis point cut in November if things weren't kind of ugly under the hood. Gold's been screaming a warning here. And so look at the USTs, the US Treasury rates here. Something's going on there. And you got the stock market at 200% GDP. How long is it going to stay there? So, there's a lot of things that are in my head, but right now we're in bullish context in S&P. That's the bottom line. There's no other way to slice it or dice it.
I want to end today with talking about, I've been waiting to pick your brain about this because you continue to talk about, I was writing down just similarities and correlations between today and the 2007
Mm-hmm.
and, in the Fed pivot. And you've been pretty vocal about
Yeah.
this. And, we've talked about this even a little bit today. Let's dig a little bit deeper into that.
One of the things about the '07 timeframe, and you were there, you were trading during that time, but
That
people
was a
who
great year.
weren't,
Yeah.
2007 was awesome from a bullish standpoint. It was long mostly.
Yeah.
Is we didn't know there was a problem in '07. That's the problem. We all know now what happened. Everyone's like, yeah, '07 was the GFC. No, it wasn't. In '07, things were great. Even at this time of the year, September 30th of '07, the Fed was saying soft landing. The Dow was making a new high today. 17 years ago, there was no crisis. There was rumblings of this home, mortgage-backed security thing. It was rumblings. It was not front and center in the markets. The S&P was making new highs. Dow's making new highs. Fed's saying soft landing. No one's really scared. We're going long. And so it wasn't bad yet. It didn't get bad until Lehman and all that in the spring of '08. That's when things got bad. But then things started to really go off the rails with the S&P as far as it went into a bear market in the first quarter of '08. That's when we kind of started saying, uh-oh, something's not really good here. What I see now is in the same type of activity in the LEIs, your leading economic indicators, housing starts, building permits, all that kind of stuff is the same now in terms of the declines. All the yields and the yield curve and all those types of things that are the same now, pretty much almost to the percent that they were in '07 at this time. And the performance of the S&P and the Dow and the divergences, because the Qs topped at the end of October in '07. The S&P and the Dow topped on the 9th on a closing basis. So when did those tops happen? They happened about a month or 3 weeks or so after the pivot, which was in September. So, and I'm seeing some of the stalling and the tiredness of the market. I know that sounds like a strange term, but that's what I'm seeing now, as I saw in late September, early October. It was getting tired. The rallies were getting more shallow, but we weren't pulling back much. If you remember that time frame, there was no big pullbacks in October of '07. It was kind of like a choppy, it peaked and then it kind of just wobbled. And then it picked up in late November, December for the S&P and the Dow, started to really have some steep drops. Again, that's what I'm seeing. I'm seeing the same type of activity in gold. So gold was on a tear. Gold went up 40% from the end of September of '07 to March of '08 when it peaked. What are we seeing now? Same performance in the commodities like oil and some of the other metals and stuff. So again, these are correlations. That does not mean we're having a GFC 2.0, but the Fed is worried about something, obviously, right? I mean, so anyway, that's what I'm seeing. I'm seeing similarities in price action, as well as in the USTs, the US Treasuries, as well as in the leading economic indicators and the sentiment. We were very bullish in the fall of '07. It was a very bullish sentiment time of trading. Everyone was like, new highs are coming. The Dow was at new all-time highs in that time frame. Very similar to today.
I mean, if there's one moral of that story is that if you were early at being short, you got killed, right? And if you were late to being short, you made nothing but money. And so
you got
trying to pick tops. Yeah. And if you're trying to pick tops right now in a bull market, even though you might see some cracks out there and you think that we're going to go lower, it's proof. If you go back to 2007 and 2008, you don't need to be the first one in short. You don't need to keep calling bearish tops. There's so many people out there saying it's going to happen. And eventually there always is going to be a major pullback. We don't know when, but as someone who's traded through so many of these, and I know you've seen so many of these bull markets, they don't go away easy. They last longer than you think. And when they finally give up, they're pretty transparent. It almost is like, it goes back to what we said. If you're the trader who's sitting back just watching, you go, okay, now you can be short because you're removed from it. Don't get too close, everybody, into looking at what's happening in the tape or the macro day to day. There's too much out there. I love how you look at the 5-day. I do as well. It's just some simple things I look at to go, I just know what side I want to be on, one versus the other. And I think that's really a lot of more of what we talked about today, John, is just find the direction. Don't overcomplicate it. You could have all these other thoughts, but it comes down to position sizing.
And I want to come back to you because you made a really salient point. If you went short with puts on the S&P in October of '07 at the top, which was the 9th on a closing basis, let's say you just did a month out, 2 months out, you would have lost your shirt because we just chopped. We didn't make new highs, but it was like you said, highs in bull markets don't die easily. It was very choppy. It was a distribution period. We didn't have steep drops until late. Well, first quarter of '08, and then we kind of had a rally after the whole Lehman thing, and then we really sold off hard at the end of the year. But you had to time that stuff pretty darn good to make a decent amount of money or else. So again, and I think the same thing's going to play out today. No way you're going to be able to call this. I am never going to do a tweet. It's going to be SPX 6,000. That's the top. No, I just think that we're in a waning stage of a bull market at this point. But that doesn't have anything to do with my trading approach because like you've been saying, it's position size, it's knowing when to get out, when to stay out, when to be in, how long to be in, those kinds of things. And we can still come out helping each other out to make some money here. And there's things to be long in too, by the way. There's lots of opportunity. We had new all-time highs in lots of sectors in '07, '08. You know that. I mean, there's places I'm going to go long that'll do well if we have a pullback in the economy.
I think there's going to be so many opportunities going forward because if we do continue to go higher, I think there's going to be lots of opportunities in the Russell. I know you don't trade that. I do. Yeah. But I think if the Russell all of a sudden plays a massive catch-up move, it's something I'm watching and I'm going, okay, if all of a sudden that breaks out from a downtrend and I start seeing those moving averages skyrocketing up, that's every day I look for the first buy set up in the Russell. I'm long calls and, I get on for that move if it happens, right? And because I think that small caps will have to play catch up at some point if this bull market really has legs. And the flip side is if it's going to be bearish or sideways, you pick and choose your moments and you know how to navigate it. I mean, that's
And
what
after,
experience
yeah,
helps you
and
with.
after the election, I'm playing energy. I mean, I just think after the election's over, we're going to see a perk up in energy. Can I prove that? No, but I just historically, energy stocks have done well after
Yeah.
an election. So, I might play calls on oil, on USO or ExxonMobil or something like that. But there's tons of opportunities coming.
Yeah. Well, John, well, this was an absolute pleasure. I got to tell you,
Thank you.
and I'm so thankful to have a chance to speak with you. I mean, like I said, been following you since you came on X, Twitter. We'll get it right eventually. I'm just calling it X and removing Twitter. But nonetheless, I mean, you're just one of the solid people out there. You're a
Thank you.
good family man. And I learned a lot from you, from your tweets. And I learned even more from you today. I really appreciate you taking the time to speak with me today.
And thank you, Anthony. It's a pleasure. You're just a stand-up guy. I look forward to meeting you in person someday when I'm in Florida. And thanks for having me on your program.